Welcome everyone, good afternoon or good morning. My name is Jason Kennedy. I am your host and moderator today for the webinar, Building a Financial Plan That Investors Will Love. This webinar is going to last about an hour. It will be recorded and emailed to all registrants within 48 hours of the conclusion of the webinar. The conclusion of this webinar will have a short Q&A period. You can ask questions by using the questions panel in your GoToWebinar module. So I will be rifling through the questions throughout the webinar, asking some during the webinar, and getting to as many as possible at the end. So again, that's the questions panel there in your GoToWebinar module. And without further ado, let's introduce our panelists for today. Alaa Ismail, Consultant CFO with Early Growth Financial Services. Alaa, say hello.
Hello. Thank you, Jason. Nice to meet all of you. I'd like to briefly kind of tell you a little bit about Early Growth before we get started here. Early Growth was a financial and accounting consulting firm that was primarily set up to help with early stage and venture-backed companies. We have grown over the years with that specific purpose in mind, where we currently have offices in San Francisco, Los Angeles, Seattle, Chicago, New York, and I hope I mentioned all of them, but several sites. We currently engage with about one of five of the venture-backed companies, or about 20%. So our whole purpose is to help emerging companies or early stage companies get through those growth years by providing various services. The core of our offering is accounting and finance. So we do basic bookkeeping and from a staff accountant all the way up to a controller level work. And that's the blocking and tackling. We will do your monthly closes on a GAAP basis. We will do accounts payable, accounts receivable, payroll, anything that you would have in any transactional level of your business. We also provide the CFO consulting. That's every engagement has a CFO, full service engagement has a CFO assigned to it. And that CFO will review your financials, provide strategic and operational consulting as needed, and essentially be your financial and mentor or assistant or consultant that will help guide you through the various stages of your growth. Other services we provide are tax services, from income taxes, state taxes, sales taxes, any tax-related work, as well as related consulting, and we also provide valuation work. So in a nutshell, that's what we do.
Great, thank you very much, Alaa. So today we're going to drill down a little bit and talk specifically about financial planning and forecasting for your startup, and particularly how you should have that together when it comes time to prepare for fundraising and what investors are going to see. And the way you're going to be doing that is you're going to be telling a story about your business, and you're going to be doing that with financials. And there's a great quote here from Guy Kawasaki. He's been a player in the startup game for many, many years. He's written a great book that's been around for a while now, but that we recommend for all founders and entrepreneurs. The title of that book is The Art of the Start. So definitely worth checking out if you haven't read it before. A great read. So what we're going to drill down and talk about today, just a quick overview here. We're going to start with the financial model and what investors are looking for. What makes up the financial model, setting your goals and objectives. At Early Growth, we're really big on milestones, so we're going to get into that a little bit. The bottom-up financial projections and the resultant spend and budgeting. We're going to talk a little bit about top-down projections and cost assumptions. And then finally, we're going to touch on reforecasting. So let's jump straight into the 3-year financial model. And Alaa, why don't you kick us off here?
Okay. I think the what Jason mentioned early on about your financial model being the numerical representative of your vision or the verbal vision that you presented at one point to another at another to your investors. So this financial model is needs to be consistent with that vision and highlight the key points of your operating plan. The first point that we have here is that it helps you understand your cash burn. I think that is very, very critical, and not only to you, but to your investors. They want to know how long your cash will last and when is the next point or inflection point that they will either need to get outside funding or re-up in funding if needed. They also want to understand it at what point you're going to be generating cash. So a model or a financial model is really, really critical to helping an investor and your management team understand that. Another thing that a financial model really helps is that it helps crystallize your operating plan in numbers. So it really helps you evaluate, what are the key performance drivers. For example, at what point will revenue grow, and how does that affect our cash burn, our bottom line, and when that revenue grows, what kind of headcount that we need to cover that growth in revenue? Product or your service development. What are the resources that you need? And once you kind of say verbally, I need 3 engineers, 4 salespeople, 2 marketing folks. Once you get that down in paper, it really, really helps you in a financial model. It really helps you see how all these items kind of gel and how you will be judged in your performance. Another thing too, that a lot of times when you do a financial model, it either validates or refutes any kind of general assumptions that you might have. For example, you might be sitting there and saying, oh, our growth rate is going to be 100% quarter over quarter, and that should get us to profitability in a year or in a half a year. But once you start putting in the operational metrics to get you to that revenue growth, you start realizing maybe that your cost assumptions are wrong, and that it's a lot more expensive to get there than you thought. So the profitability threshold is extended. Or it could actually validate, go the other way, where you find out that revenue growth will help get you to a lot higher profit level, and that may adjust some of your outside investment strategies. The other thing that a model does is it essentially lays down a roadmap. It gets you back into perspective from the verbal assumptions that you might have made. I think a financial model really clarifies that and helps you and your team get things in perspective. The one thing I'm going to keep stressing about a model is that it is iterative and it is evolving, and it's a breathing document. It's a living, breathing document. You will continuously improve on your assumptions. You will continuously change your model. It's never set in stone. So the iterative part about it is that it's key that this model be part of your team's goals, and it's not something that a CEO sitting with his finance person will do alone. It's usually something that you need to have your team's input. When you have a model, it helps you going forward in clarifying your decision-making process. Should I hire this person? Should we implement this marketing program? and so on. Once you start getting that implemented in your overall financial model, it gives you clarifications and helps you make these decisions. And then at the end of the day, your financial model is your scorecard. Your financial model is going to be key for lots of different things, for basic things like insurance coverage and D&O insurance to really big things like valuations. And essentially that is what most entrepreneurs or startup folks are centered around. You know, what kind of valuations am I going to get based on my growth rates? So these are, you know, some basic reasons why a 3-year financial model is important.
Great. And as far as the meat and potatoes, what goes into a 3-year financial model? We've got most of the big players here as far as what needs to be inside, right?
Right. You know, when you're doing a financial model, it's really, really important, especially if you haven't done it in the past, to have guidance. And one of the things I coach a lot of early stage entrepreneurs is make sure that you have a template in going into the modeling process. And essentially that template revolves around 2 types of forecasting. One is bottom up and the other is top down. We'll get into what those are in a little bit more detail later on. But within that 3-year financial model template, you need to identify certain things. What are your objectives? Usually you've already probably laid that down. We need to develop this product by such and such a date. We need to have these features in our product. We need to be in these markets, whatever those objectives are. And that's the reason why it's on top of this. That's where you start. It's your outline. It's the basis that you're going to start kind of filling in the blanks from. By timeline, we mean that, you know, these objectives that you have in mind, when and where are these milestones going to be met? We're going to develop XYZ features in our product by Q3 of this year, that kind of thing. So lay out the timeline from both the revenue and expense side that kind of helps you in generating the model. What are the key variables? Do you need to hire people? Do you need to get consultants? Do you need, you know, do you need to raise money? Identify what those variables are before you start your financial model. It's not to say that you need to have everything in place, but the more you could identify prior and the more you could plan for your model prior, the better the modeling process will be. You have to come into a model with certain assumptions. There is no way that you're going to have everything set in stone. So revenue growth rate assumptions, you know, assumptions on when certain product features will be in there. And then identify those assumptions with whatever kind of overall milestones that you may have. A key milestone may be the next financing round. A milestone is a key milestone might be certain customer acceptance criteria. So those are kind of the essential components to your model that should be kind of laid out prior to you starting the modeling process.
Great. And specifically on the major objectives, what's the best way to identify those for your startup in particular?
So the major objectives is to figure out really what you need to get there from a financial point of view. You know, how much money do you need? How much money are you going to make? That's the overall kind of reason why you put your objectives down in a financial model. So am I going to be going into a venture funding scenario? Okay, so how long, if that's the case, how much money do I need to raise? What's my cash burn? going to be? At what points do I need to raise additional funds? What are those milestones? Um, what do I need to do to get to the next raise threshold? Um, what are the related valuations of the company that I can expect within those milestones? It could be that when you do your model that you find that not in every business model that's a cash burn, but you're generating cash, you're profitable. So you may not need to get to that next threshold if you're a venture-backed company. You might have a different strategic objective based on that result. Um, so a model really helps you see where you're going. It's a roadmap to where you're going, and then sets the related company objectives to meet those goals.
Now, we've mentioned cash burn a couple times already in the presentation here. Can you get a little bit deeper into what cash burn is and why it's important at this stage?
Sure. Cash burn is, in a kind of a general sense, is how much cash you're using on a monthly, quarterly, or annual basis. Cash burn is typically identified in three buckets. One is operational. That's the cash that you're burning or generating from your day-to-day operations, from your accounts receivable, from it generally reconciles your book loss or book gain to your cash balance at the end of the month. So operating cash burn is cash used or generated from your business operations. Another component of cash burn or cash flow is financing activities. Financing activities are essentially debt and equity transactions. Are you raising money? Are you getting an equity line of a venture debt line of credit? Are you getting an accounts receivable line? Are you getting an inventory line? Those things affect your cash and need to be separated because they're separate from your day-to-day operations. And finally, it's investing activities. Investing activities generally revolve around capital expenditure. Do you need to buy equipment for your venture? You need to, facilities, computers, etc. And they're separated for a reason. Usually, investors want to see your operational cash flow because investing and finance activity are sporadic and are not reflective of what your business is really doing. They happen every once in a while, and just because you raised $10 million in a particular quarter, that doesn't mean you've generated $10 million worth of cash. So cash burn is really, really important for yourself and for the investor to figure out your runway, how long the existing cash will last, to figure out how much cash you're generating. Do you need to get outside cash, or are you generating enough cash to facilitate strategic transactions like acquisitions, mergers and acquisitions? So in a nutshell, that's what cash burn is.
Great, thank you. So let's get a little bit into actually creating the model, some of the pieces of the process of getting everyone involved, starting with getting stakeholders and then the management team involved, right?
Absolutely. I don't think a good forecasting or modeling process can happen without collaboration of your key stakeholders. Now, it could be very early on that it's just one founder or two founders that are doing this, but in general, when your team is, when you have some investment in the company and you have some momentum, you probably have some kind of a team. So start with, if you're in a revenue, if you're generating revenue, start with your sales folks, your, the people that are generating your revenue. Figure out your pipeline. A revenue pipeline is really, really important, especially in a bottom-up modeling or forecasting scenario. And again, we'll get to the difference between a bottom-up and a top-down later. Identifying your pipeline or your revenue model is going to be really, really key, because that's what investors focus in on with laser precision. They will challenge you on that. They will ask a lot of questions. So getting your revenue model not only helps with your forecasting, but it really helps in telling your story, as it's such a key part of the financial model. Product, get together with your engineering team or your development consultants and figure out what are your short-term plans and your long-term plans, and what resources you need. Do you need to hire people? Do you need to get outside consulting? Um, and what are the related costs that go into you meeting certain product goals? And so that's really, really important. Figure out what kind of market that you're going to address and how you're going to take advantage of that market. And usually that's marketing tactics. You know, is it online marketing? Is it direct sales? Is it different types of approaches to address what your market is? And finally, kind of strategic goals. At the end of the day, are you setting up your company for IPO, or are you setting up your company for acquisition? Get those strategic goals in your mind when you're doing your modeling and the related timing, so you could incorporate that as needed. So once you compile all this information and discuss it among your team, I really like to then put that information into a financial model. Figuring out the head count, figuring out the revenue, along with the consultant that you're working with to help you generate this model. Get all of that information into the model at first. Don't do an evaluation until kind of the initial dump, and then see what it looks like. 9 times out of 10, you'll look at it and you'll be surprised. Your revenue projections are optimistic. Your expenses are way higher than what you thought when you started talking about it. And from that point, there's a dialogue that happens with your salespeople. Can you really grow revenue at 300% month over month? With your product team, do you really need 100 engineers to get this feature? Or do we need to outsource our development? And then that kind of dialogue going back in conjunction with your financial consultant helps you then create that bottom-up forecast.
Great. That's a great segue into the bottom-up forecast itself. And, we've got a great blog post on this. You can actually just Google bottom-up financial projection. It's usually the first or second result. So some additional reading for those of you that want to do some more homework after the webinar. But let's get into it here. Let's talk about the bottom-up projection.
Sure. So when you're presenting a 3-year forecast, I counsel my companies to do a 1-year bottom-up and a 2-year top-down. 1-year bottom-up is essentially a detailed projection or forecast. I like to start with revenue, and by detailed revenue forecast, I mean pipeline, as opposed to saying I'm anticipating my revenue to grow 25% monthly. It's more in the lines of here are the companies that we are addressing. Here is the number of subscribers that we are planning to grow. Very, very detailed revenue projections in the model. It's not just kind of a finger in the wind type revenue projection. That is going to be really key for your investors. If you have a board, I'll guarantee you that pipeline is going to be reviewed. That's one of the few detail items that board members like to review. And that's typically where I start in my bottom-up forecast. The next will be departmental in nature. Go to your sales and marketing people and say, okay, here's our revenue projections. What do you need to get to these goals? Um, and your marketing team or your marketing representative or just you will say, here's the marketing programs that I need. Get those costs um, and timing of those costs down and put that into your budget. Again, the support for your forecast and budget will be detailed, will be these marketing programs, this trade show events. I'm going to create this marketing collateral. On the sales side, I'm going to hire certain sales folks. I'm going to do these sales programs. I'm going to invest in my sales and marketing effort in these specific ways, as opposed to my revenue. My sales and marketing budget is going to grow at a 20% quarter to quarter rate. On your R&D, it's essentially, or your operations, figure out what you need to do to address your growth needs and your product development needs. How many people are you going to hire? What are their job titles? What do you anticipate the salaries for those folks are? And so just get an overall headcount projection, because that tends to be your biggest cost item. Then after that, backfill with general expenses, your office rent, your insurance, your back office needs, accounting, legal, and so on. So that is really what a bottom-up forecast will look like. It's very, very detailed. It's on the revenue side, it's customer related. It addresses your product development and your R&D needs, and whatever. The final thing that you should look at is your capital spend to achieve your goals. How many computers do you need? How much office furniture that you'll need to address that growth? Do you need to acquire facilities? Do you need certain machinery and equipment? Get all of those costs down, and with the help of a good financial consultant, you will be able to put that in a financials framework and get a really, really good bottom-up forecast.
Great. So let's talk about everyone's favorite topic, budgeting.
Yeah. So one of the things we didn't address, and we do address in other webinars, is accrual-based and cash-based financials. One of the things we really push at early growth is for our companies to be on an accrual basis. There's really, really good reasons for that. And before I get into those, accrual accounting simply means that you recognize revenue when it's earned, and as opposed to when you receive the cash, and expenses when they're incurred, as opposed to when you pay those expenses. Cash basis revenue is recognized when you receive the funds, and expenses are recognized when you pay the expense. Accrual-based accounting is more widely used in business. It is a more accurate way to reflect how your business is doing. For example, if you have a long collection process and you're collecting your revenue, say 60 or 90 days after you earned it, you might have this lumpy financials where in one month you had a great collection month and your revenue is really high, and in another month your customers didn't pay and your revenue is really low. So from an evaluation point of view, cash basis is not really widely used. And the same happens with your expenses. Certain months you might be paying a lot of expenses, you might be prepaying certain things, and your cash is used up quickly. But accrual base puts those revenue and expense items in line of when they were earned and when they were incurred. So the budgeting process should also reflect your accrual-based accounting. And one other thing that I want to stress is that your budgeting and forecast should line up with your financial statements. One of the things that I see a lot in the companies that I work with is they will have a forecast and budget model, and then they will have the financials. And a lot of times those two things are not put together. It's important that both those documents become one and the same, where your financials are flowing into your forecast. That does a lot of things. It gives you perspective. It tells you where you've been and then aligns it with where you think you're going. So it might raise questions. So for example, if your revenue has been growing at a 10% month over month, and then all of a sudden your forecast is showing, 50 to 100% monthly close, you could just see that visually and say, wait a minute, are my revenue assumptions correct? It helps you identify items in your budget based on your actual spend that you may not have identified. Oh, look, there's a software license that I paid for last month that I didn't take into consideration in my forecast. So budgeting and financials need to be perfectly aligned. And because your financials are typically going to be on an accrual basis, your forecast also needs to be on an accrual basis. I like to have all my companies, even if they're really small, segment their financial reporting into departments. Typically, I use sales and marketing, operations or engineering or R&D, and general administrative. And that helps you in your budget process kind of in the way that you think. Even if you don't have formal departments, it helps you kind of focus on your operations by operating departments. And finally, accrual basis then helps you align your expectations with cash flow. So for example, you may have rapid revenue growth, but in your business you might have to extend long payment terms. Or you could be a SaaS company where you're getting your revenue paid in advance for quarter or by year. And getting an accrual-based financials helps you align both the revenue and the related cash in a more accurate way. And then finally, I think having a really good budgeting process on an accrual basis helps you identify if your revenue assumptions are in line. And it helps you create different scenarios by adjusting all these variables. And it becomes a really great operational tool.
So a typical budgeting exercise, we talk a lot at Early Growth about milestones.
Mm-hmm.
So what should a founder entrepreneur kind of be preparing for as far as a budgeting exercise goes?
So, I think I said early on, a budgeting exercise is a budget is a living, breathing document. Now, that doesn't mean that you are reviewing your budget on a daily basis. I think, but a regular review, whether if you're reporting your financials monthly, you need to kind of look at it and evaluate your budget forecast assumptions related to your monthly financial. And then look at what, again, it's an iterative process. Go to your stakeholders, your department heads, your team, and say, okay, here's where we've been, and here's what you forecasted last month, last quarter, last year. What do we need to do to adjust? A lot of times it may not be adjustments in your actual budget, but it might be adjustments in your operations. Also, a budget exercise, when in line with your financials, helps you then evaluate trade-offs. So, your revenue forecast is not what you had anticipated. What do you need to do to react to that? You're doing a lot better. You're able to develop certain features in your product a lot quicker. So how do we then adjust our revenue model to take care of that operating result? So a process evaluating your financials to your budget, a regular process. The more regular, the better it is for your operation. Helps you make a lot of different decisions and keeps you on course and reduces the amount of surprises. From an investor point of view, having a team that is perfectly aware of all of these variables makes them feel so much better about their investment in the company because they really feel that their money is being taken care of and that the team has their eye on the ball.
All right, so we talked about the bottom-up projection. So, Alaa, can you tell us a little bit about what goes into the top-down?
Sure. So a top-down projection, I usually ask for a top-down for forward-looking years. So 1 year bottom-up, and if we're doing a 3-year model, 2-year top-down. So if you've already created a 1 year bottom-up, then for your top-down, you would start with some general assumptions. So on your revenue, for example, you could say, well, you know, my current revenue is addressing this market size. I'm anticipating that that market grows by a certain percent. Or I will be entering into these markets, so therefore my revenue will grow, you know, by a certain factor. So from a revenue point of view, you're not identifying specific accounts or pipeline. A top-down projection would be a revenue growth rate based on certain underlying assumptions. Figure out what kind of business segments that you're entering. How does that affect my revenue, and how does that affect my cost? It might be that I am now, in 2 years, I am going to be in the market and I'm going to be selling. So I'm going to be switching my focus from a product development stage to a sales and marketing. So I need to increase my investment in those areas. I don't do a bottom-up forecast where I'm saying I need to hire these sales, these marketing people, but it's more of, again, a projection based on percentage growth. So a top-down is more like an extension of your bottom-up, and it is based on certain assumptions. Don't just say, well, we think it's going to grow by 20%. We're going to grow by 20% for the following reasons. Typically, 2 or 3 year top-down projections are not held in the same scrutiny by investors, but it is necessary because they want to know what management's vision into the future will be, or what it could look like. And based on those kind of general assumptions or operating plans, they could then ask key questions or challenge the management team to verify their operating plan. Another thing that, you know, kind of the unwritten thing that a lot of investors is they want to see where the company's going and what kind of return. And that's really what a top-down projection also helps with, is it helps give somebody a picture of where they're going to be in a couple of years from a valuation point of view. And to say, okay, if the company expects for it to be at that place, you know, that means in a conservative way that I'm going to have good growth and good return on my investment. So it becomes very, very a critical investment tool and evaluation tool.
Now, you've mentioned a couple times that the financial plan is living and breathing. It's not set in stone. So that means that at times it evolves. We've got to talk a little bit about readjusting, reforecasting. So what does that typically look like?
Right. So I get in a lot of hot water with certain investors by saying to them, you know, I'm not sure why you're doing presenting a 5-year plan. And I think even 3 years is something to a little bit aggressive, but again, it's expected out there. So, you know, look at your long-term plans with a little grain of salt. One of my econ professors always said that there's one certainty in long-term planning. In the long term, we'll all be dead. So, so don't focus so much on multi-year plans, but update your budget on a regular basis. I don't think you need to do a formal budgeting process monthly, but I do believe that, especially in tight situations or in companies that are in their growth mode, that a monthly look at your forecast is really important. It could be that it's fine tweaks. For example, you had anticipated hiring these people in July, but for whatever reason, they were not hired in July. They're now going to be hired in September. So regular updates really helps you kind of get in tune with your financials, and then also helps you revisit your assumptions. You may not have remembered that you had certain product development tasks that were supposed to be done at the end of the month, and your forecast kind of tells you that, and then will help you go back to your operation team and say, wait a minute, we planned on creating these features at the end of Q2, and I don't think we're even close, so let's revisit that. So I think, you know, regular updates are really, really important, and to be done sooner, or at least in conjunction with your financial reporting methodology, your actual financial reporting methodology. So investors, of course, probably will not want to look at your forecast on a monthly basis. When you're presenting your budget and your financials to your investors, one of the key things that you should keep in mind is that you should tell them what has changed since the last time you presented to them. So typically when you present your financials or your forecasts to your investors, you're not probably not doing it on a monthly basis. You might be doing it on a quarterly or on an annual basis. But tell them, you know, last time we forecasted our revenue to be X. Now our revenue, the actual results were Y, and here are the reasons why. We are now forecasting our revenue to be this, and here's the reasons why we've adjusted our assumptions. I think that is the key messaging to your investors for your forecast. I don't know of any investor or board that wants to get into the minutia, you know, why your office supply expense increased, but they really want to know the general business trends. You know, are you getting traction into your market? Are you developing your product as you said you would? What are the challenges out there from competition? And all of that relates to your model. And then finally, I think the key thing in reforecasting is it changes your timeline assumptions. It could be as critical as saying, hey, we thought we were going to raise our next round of funding in Q3 of 2017, but it looks like we're going to need to push that back. So we need to start getting going and finding new investors, or going back to our investors and asking for more money, or we need to address our cost growth plans. So reforecasting is very, very important because it aligns your actual results with and realigns your actual results with your forecast.
Great, thank you very much, Alaa. So we're going to move on to the Q&A portion of the presentation. Again, as a reminder, you can use the questions panel in your GoToWebinar module to ask questions. We've got a few that are in already. So I'll start with one here, a little broader question for you, Alaa. Is there a certain revenue growth percentage from year to year that VCs like to see?
I think the short answer is no. I think I'll tell you what VCs and investors don't like from a revenue forecast. They don't want to see things like the total market in China is 1 billion, and we anticipate of addressing 1% of the Chinese market, so our revenue assumption is that. Um, I think a lot more granularity is better, and I think investors like to see the basis for your assumptions as opposed to the growth rate. And based on those assumption basis that you present, they will then evaluate whether your forecast is ambitious or too conservative.
All right, thank you. And another question here, when it comes time to meet with investors, do they prefer a company that's doing cash accounting or accrual accounting?
I think it depends on the stage. I think in a seed round or an angel investor, I don't think financials matter very much. So your results very, very early on may not be important, but I think that if you are a little bit more established, they would definitely want to see accrual-based, or at least you taking into consideration accrual-based accounting in your forecast. One of the examples I give here is SaaS companies, especially companies that have some kind of subscription model. I think you need to align with your potential investors the cash and the revenue very early on, and accrual-based does that. But if you don't have accrual-based financials, make sure that you address those differences in your investor presentations early on.
Okay, a question about reforecasting here. What are some of the typical changes you'll see in a budget that's being reforecasted?
Right. I think that the two most typical changes are revenue and headcount. They're the biggest items, and those really affect the results. I rarely see changes in minor things like general administrative expenses and those kind of things. But those are the two biggest changes that I see on a regular basis: is headcount, hiring plans, and revenue projections.
Okay, got a long question here. I'll see if I can paraphrase here. What are the mechanics of comparing budget to actual and for reforecasting?
Oh,
Do
excellent
you end up
question.
do you end up manually copying the actuals into your Excel financial model from your accounting system, or what does that look like?
God, that's like it's almost like I wrote that question down. Yeah. So the one of the things that the discussions I have with a lot of my clients is that very, very early on, I align my chart of accounts and my accounting process with the forecast. So, for example, when somebody forecasts certain headcounts, I actually make sure that that headcount forecast is aligned with the different departmental payroll reporting. If somebody is forecasting, a certain office expense, I want to make sure that the forecast is aligned with the actual financials. So one of the things I do is I create my financial model. And unfortunately, the model is in Excel just because a lot of the companies that I work with are using either QuickBooks, and Excel becomes our forecasting and modeling tool at very early stage. And I cut and paste. I try to create the model that is in line with my chart of accounts and ask for the forecast to be input in the same line items. So when the financial results are created, they are perfectly aligned with the forecast. So I use my financial reporting model or spreadsheet in the same way that I use my forecast. They're the same document when I engage with companies, and I encourage other people to do the same, because it not only helps you with your forecasting, but it also helps you with comparing actuals to the forecast in later stages, and giving you ideas of what some of the variances and causes of the variances are.
Nice. So an interesting question here. Should startups provide both an optimistic forecast and a more conservative forecast for investors?
um, so I just went through an exercise where it was in a board meeting. A salesperson actually came up and said, these forecasts are a little bit sandbagging. I'm going to kill these forecasts, but I just wanted to be able to really beat them. So I gave you a low number, right? So that was not very well accepted. And on the same token, that if you come in and you don't present it with any kind of explanation saying that this is a sandbag or this is an aggressive, I think at the end of the day that there'll be questions, and if you have savvy investors, they'll be able to dig through your general assumptions. I believe that you should be as realistic as possible with your investors by not overblowing the expectations, because I think that will come back to haunt you. If you're able to get buy-in on your revenue growth, aggressive revenue growth, and for whatever reason you don't meet it, just know that somebody is going to ask you why. So the guidance I would give is really work on your revenue model, and really challenge yourself to say, am I going to be able to achieve that? So not to be too aggressive, and also don't be too conservative, because after a couple of quarters of you blowing your forecast away, unless you have a very good reason of why you forecast for that, they're not going to be taking your forecast very seriously. So at the end of the day, your forecasts are only as good as your credibility. And the more reason, and that's not to say that your investors are going to expect you to be perfect. They're not. But they're going to expect sound, rational reasons why you don't, when you are below your plan, or sound reasons why you exceed your plan. And that kind of transparency and honesty with your investors is really important on an ongoing basis. For new investors, it all depends on how savvy they are. But my guess is that a savvy investor will have an idea of what kind of, say, revenue projections that you have, whether they're conservative or aggressive.
I've got another great question here that may try to paraphrase here. If you're entering a new market or don't have historical data to work from, what's the best way to develop some assumptions on market share and potential revenue targets?
So that happens all the time, and I think that when you're entering into a new market, not only you but your investors know that there's a lot of unknowns. Again, it goes back to assumptions. One of the things I use is to see what other companies that may have addressed that new market are doing, and basically go off of that. So, for example, if there's a competitor that is already in that market, and I have an idea of the how much of that market that competitor is addressing, I base my forecasts off that. If it's a brand new market and I have an idea of what companies that I'm going to be focusing on, do a general kind of spreadsheet analysis saying these companies typically spend X in this for this product, and I'm planning to address this percentage of that. But have some kind of thinking of what that new revenue line will look like, and lay out your assumptions early on, and those assumptions will be fine-tuned as you go. So the bottom line answer is that I don't think anything is going to be perfect, and if I didn't get this message in the beginning is modeling is not a perfect exercise. It's not going to be, you know, rock solid, and your investors are not going to, you know, beat you up every single time that you miss it here and there. But what it is just an honest reflection of where you think you're going to go based on the best set of assumptions that you have and the most recent information that you have at that point. And I think when you enter that modeling exercise with that frame of mind, I think you'll be successful.
All right, I think we've got time for one more good question here. Lots of great questions. Thank you, everybody. What tools do you recommend for forecasting and revenue recognition outside of Excel?
Oh, gosh. Huh. So, you know, revenue recognition is usually, I think a lot of people put a lot more difficulty than needs to be. So, you know, for the most difficult kind of revenue recognition scenarios that occur typically are in a SaaS model where you have monthly, quarterly, semi-annual, and annual subscriptions, and you need to model that out. There are certain tools out there that are coming online that help you with that. But so when you put in your different bookings quarterly, they will essentially do that waterfall for you. There's a company that I know of based out of Georgia called SaaS Optics that helps with that. But most of the tools that I've seen are just kind of souped up Excel models. So at the end of the day, outside of the really, really large enterprise type systems like either a NetSuite or a Oracle or those, Excel is really the best model that I know of. The other one that I know off the top of my head is SaaS Optics.
Okay, great. Thank you very much. All of this was fantastic. Thank you again for spending some time with us and sharing your insight. And thank you to everyone that attended. As a quick reminder, a recording of this webinar will be sent to you automatically via email within the next 48 hours. So you'll have a copy to keep handy for reference. Again, thank you everybody for attending, and have a great afternoon.